So now I would also like to welcome the new joiners who have joined us and the ones who are here with us. We appreciate that you have taken out your time. I hope you're enjoying these sessions. So now that we have known more about the Indian digital infrastructure, we are going to discuss in detail what is value investing and special situations, particularly on whether merger and acquisitions create value. So we all are aware that merger and acquisition is a quite common phenomena seen in the industry, and merger and with companies using them as a means to grow and expand their businesses. However, the question remains, does merger and acquisition create value for shareholders? In value investing, the focus is on identifying companies that are undervalued by the market and have the potential to generate long term returns. Special situations, on the other hand, refer to unique investment opportunities that arise due to specific events or circumstances such as merger and acquisition transactions. So, to discuss this in detail and dig deep into this topic, we have with us Mr. Neil Bahal, founder and director of Negen Capital. Mr. Neil has worked on a varied variety of consumer categories, including FMCG, OTC products, and consumer healthcare. Negen Capital is a Mumbai based debt syndication and private equity advisory focusing purely on mid market deals across sectors. They have successfully raised capitals for some of India's fastest growing companies in auto, alcohol, iron and steel, logistics, power, and telecom services. Now, I'll be handing over the mic to Mr. Vikas Agrawal, who will be in turn be handing over the mic to Mr. Neil Behel. Over to you, sir.
Yeah, thank you, Pragya. Hello, Neil. How are you?
I'm good, Vikas. Bhai, how you doing?
Yeah, all well. So you can hear me, right? And I can hear you loud and clear.
Yeah, loud and clear.
Absolutely fantastic. So thank you so much for taking the time out and joining this session.
No, thank you for creating such a wonderful conclave, and this is a very good platform to interact with. And it's an educative kind of platform even for us. Very good speakers are here and talking a lot of good things.
Right. So the whole idea is, as I said, to organize this conclave. The topic that we have chosen is the golden decade for India. India is going to be Sone ki chidiya once again, and people are talking about this decade is going to be, a decade which our parents would have not seen it, or maybe our kids may not be able to see. That's the kind of wealth creation that is going to take place, and there are a lot of value migration themes out there which are working out well for our country. Firstly, Neil, many congratulations for running your PMS, which you've been doing it for last 4 years now, as we speak. And of course, we like portfolio managers who make mistakes and learn from their mistakes and evolve, because that is something. I mean, I can't say that nobody will ever make the mistake. So mistakes are part of the journey. And the way it has been evolved is that you've been not only outperforming the benchmark but outperforming various peer group also, and on a consistent basis. We thought, who would be the better person to talk about what is called value investing with special situation, because first of all, there are very very few research companies out there in India which are which are sort of doing it so systematically, very methodically, the way you do it, in terms of identifying opportunities. And you call it special situation, which is either merger, acquisition, or you look at when is the company going to merge with another companies. So of course we'll talk about that in detail. So we thought, who would be the better person than you to talk about this. So thank you so much once again, and if you wish to use any of the slides, please do so, and over to you.
No, thank you so much. Are you able to see my screen?
No, you need to go to present, and from there uh, click on the share screen. Yeah, and then on window. Yes, correct. We got that. I can
Was
see
it there
this.
right now? Can you see the screen?
Yes, very much.
Okay, wonderful. So,
Yeah.
so this is a very interesting topic. Unlocking value via special situations. Now, special situations is a very fancy word. A lot of the investors have not heard of this. What is special situation? So if I just start from the basics, special situations is nothing but value investing done in a different way. Now, What is value investing? We all know value investing. Warren Buffett has made it very, very famous. This is like the best way to do investing. We have to identify a bunch of good companies. Let's say, you identified Asian Paints early on, and at that time it was very cheap also, and you bought it. So the idea is to buy a very good business, but pay a lesser value for it. The problem is that this is easier said than done. It's just not possible in today's scenario. If you see a lot of these good companies, they are super expensive. We'll cover all those things in the slides ahead, but I just wanted to first cover that the value investing means buying a good business for a cheap price. This is the best way investing should be done because this gives us a lot of margin of safety. Warren Buffett, the late Mr. Junjunwala or R.K. Damani, all the big investors in the world, they've always only done value investing. You would never find them buying a, like, even the late Junjunwala. I mean, he would not have bought Titan today. He bought Titan when it was a smaller business. It was cheap enough for him. So value investing works like that. You're trying to buy a good business, but you're very much keeping an eye on the valuations. So this is what basic value investing means. Now, what are special situations? Now, special situations are a slight variation in value investing, whereby companies are doing certain corporate actions to unlock value. Now, I'll give you a small situation. We'll also cover similar kind of things in the later slides. I've kept it very small. I don't want to bore a lot of people with too much details. I'll just cover the overall the theme of it. So, special situations. Let's say, I'll give an example, hypothetical example. Let's say there is a conglomerate. Now, a conglomerate is into, let's say, two businesses. One is the main business, which is like, let's say, 90% of their income, and the other business is, let's say, some other, let's say one is the IT business, one is the tire business. Now IT business is for 90% the income comes, and the tire business, let's say, 10% comes. And every year the money they make in IT, a lot of the money starts going towards the tire business. So the shareholders say, oh, you, what is this going on? I have invested for the IT business. Why are you wasting away the cash flow of the IT business into this tire business, which is so small? While the tire business is a good business, you are investing for the future, but for the current situation, it seems like capital misallocation. So, these guys say, okay, fine, we will demerge it. So whenever a demerger happens, a lot of these existing investors, they start selling out these companies. And once the selling comes, these companies fall to a very, very cheap level. So basically, special situations and value investing is the exact same thing. You're trying to achieve the exact same goal. You're trying to buy a good business at a cheap price. The only problem is, in today's day and age, markets are such that all the good companies are expensive and all the cheap companies are duds. So doing value investing in today's world is, in my opinion, not a very effective way. You can't do it unless there's a deep bear market where everything becomes cheap. In a normal market condition, you can't do value investing. So you're either going and buying a Trent at 100 PE, or you're going and buying some sunset company, where it's everything is not going good. You're buying it at 5 PE. This is not going to work. You need to have a good company with good growth prospects, but you need to buy it at a cheap price. So that's why we look at things like special situations. I'll just cover them a little bit more in detail. So why special situations? I've just put a little bit of uh, lines which are kind of jokes, but it's actually true. Life isn't fair. You want to do special situations, but as I just said earlier, the good companies are insanely expensive. If I can ask you, name me 10 companies which you think are outstanding businesses, but all of those 10 companies, the price to growth ratio would be very, very high. PEG would be very, very high. So, and the cheap ones, the ones which you find them, below the 10, if you do a screen and you find the cheap companies, let's say below 10 times earnings, they're all going to be situations where, it's a print company, or its company as a promoter which is not doing good, that kind of stuff. So this is where special situations can end up giving us a very good edge, and this is why I have been following this myself since a while. And it's not just that our fund in FY21, FY22, and FY23, in the last 3 years, we are one of the top performing funds in India. It's not because we are, it's not a one off. If you go back in time and if you take the historical data, global data of special situations across the world, you will find similar kind of performances from similar funds. So, starting off in the 60s, early 50s and 60s, when Warren Buffett was managing his own fund before he started Berkshire. He was managing the Buffett partnership. So he was a special situations expert, merger arbitrage or companies where something is going on in terms of a demerger, delisting. He was only largely doing this. He was not wanting to take a call on the macro situation. He was trying to figure out what can be in his own destiny, what he can, kind of figure out himself. So he started that. He had a track record of 30% CAGR over some 12 years where he didn't have a single down year. He was doing simply special. He used to call them net, that those kind of names he used to give them, because that time the name special situation never existed. Special situations, the term was coined by a person called Joel Greenblatt, and his fund did even better than Buffett's fund. Over a 12-year period, Joel Greenblatt's fund created a 52% CAGR. Again, in those 12 years, he never had a single down year, and he completely crushed the S&P 500 and the Dow Jones and the Nasdaq. Everything that you compare, whatever you want to compare him with, he crushed everything. And this is not all. I can give you further data. So then the people in academia, they thought, let us do some actual background check on, back test on special situations, and they did something. The university, the Penn University in the US, they said, okay, let's buy all of these special situations, all of them. Don't figure out what is good, don't figure out what is bad. Let's buy everything and make a portfolio and hold this portfolio for 3 years and keep repeating. So the situation was such that after a backtest of 25 years that they did, the result was that this complete special situations portfolio, whereby you're buying everything, that portfolio created a 20% CAGR over 25 years versus a 10% CAGR for the S&P 500. So why special situations? Because this is the one way, the one realistic way where you will get a chance to buy a pretty decent business at a cheap price in today's world, where the business is not cheap because it's bad, but the business is cheap because other people are selling out because they don't want to own the stock. I'll just cover them a little bit in detail now. So we all heard, Mr. Warren Buffett it talks about Mr. Market. There is an imaginary thing called Mr. Market, who is sometimes a manic depressive. He's too sad in a bear market and he's too happy in a bull market. And our job as an investor is to ignore Mr. Market and see what is going on in our portfolio and take advantage of Mr. Market's, mood swings and behavior. So this is what Buffett used to joke about. Now, I'm telling you, there is a new class of, kind of a Mr. Market. This is a Mr. Fund. The Mr. Fund is also similar. Mr. Fund also doesn't care of fundamentals, and Mr. Fund also, like a Mr. Market, is a manic depressive at times, right? So I'll give you a small timeline to just tell you how Mr. Fund works. A conglomerate spins out a non-core division. Let's say a division is not making profit today, but it has great potential for tomorrow. And shareholders, these large funds, they are saying to the promoter all the time, why are you, misallocating capital? Why are you putting capital from the big business into the small business? Which is also fair. I'm not saying that is not fair. It's fair. They are right in their own way because they are investing for the bigger business, which is the cash cow, which is the stable business. And it's not good that the management is putting a lot of the cash flow earned from the big business into the smaller, unrelated kind of, something different business. So the management says, okay, fine, we'll just do a demerger. We'll spin the two companies separately. So you can own the company that you want, and the company that you don't want, you can sell. So what happens? The demerger happens. The fund, this big large cap fund or a big pension fund or an FII, these big funds, they get two stocks. One stock is 90% of the value of the conglomerate. Other stock is just 10% or let's say 5%, and it's a completely unrelated business. Now, demergers by design is the most inefficient way of splitting a share, but it is the only way. So it is something that needs to be done, but it is something that is absolutely horrendous. So the fund, this big fund who gets the stock that he wants, he'll keep that obviously, but the stock that he doesn't want or he's not allowed to own, let's say a large cap mutual fund gets a small cap, he's also not allowed to own it. So sometimes they don't want to own it, they don't like it. Sometimes they are not allowed to own due to a lot of these regulations that SEBI has put. Large caps can own large caps, mid caps can own mid caps, small caps can. So there's a lot of rules and regulations that these guys have to follow. So for whatever reason, whether they can't own it or they don't want to own it, these funds start selling. And when they are selling starts, it doesn't make any sense, as if they're drunk. The thing is that even if the stock is, I've seen a lot of fund selling happening when a stock is, on a forward basis, something like a 7-6 times earnings, likely to grow 20-25%, still they are selling. So we have, as investors, have got to take advantage of this window of opportunity post every demerger. Whenever these funds are selling, this is an opportunity, because when they sell, two things happen. Either the company which is listing will list at a discount, so it lists lower anyway. And if not, let's say it lists at a fair value, then over time the fund selling can take place over 1 month or 1 year. Over time, this stock can start drifting lower, or even if the company is grown in a year's time, let's say by 25%, the stock will not go up because this fund is still selling and the bunch of these funds are still selling. So this is what our opportunity is, and there are so many examples. I can, off the bat, I can give you some past examples. Of course, this is not investment advice, and whatever I may say today, don't use it as investment advice. This is just something on an educational basis. I just want to give you examples so you will get better perspective. So this was CG Power, where Murugapas came and they bought it with Mr. Velayan, one of India's best promoters. He came and he publicly said that, Tube Investment and CG Power, there are great synergies. This is my plan and this is what I expect to do. And everybody who was tracking CG Power, they thought, let's just buy it. But the CG Power stock never went up in the initial few days. Why? Because these bankers, they didn't care what Mr. Velayan, who he is, the best promoter in India, let's say, and what his plans are, what the fair value of the business could be. They don't care. So they were selling the stock at something like 12 rupees, 13 rupees, millions and millions of shares they were selling at 12, 13 rupees, while the fair value easily was 40, 50 rupees at that time because of Murugapas entering the business. And then, if you got enough time to do your work and buy something because somebody is a forced seller. Same thing is happening in I'll not name it because this is a live thing and we own it. There is a pharma company which demerged right now. And in the first month's data itself, 7 mutual funds completely exited. The stock listed at 315 and the stock fell all the way to 235. And on the day when it went to 235, there was a large block deal, and it emerged in the evening that JP Morgan, which is a big FII, they sold out completely. Some 7-8 lakh shares they sold out completely. So these kind of situations, the company is good. Okay, there's nothing wrong in the company, but the stock is falling, or the stock is drifting lower, or despite good performance, the stock is not going up. This is the opportunity for us. So why special situations is basically, this is the only real way today to do value investing, unless you're in a deep bear market. If it's a COVID kind of a crash, then you don't need to do special situations. We also just gave up on in that COVID crash. We went and bought Chola, we went and bought Bajaj Finance, because you don't need to do value investing via special situations. You can do simple value investing that works in a bear market. But in a market like FY21, a market like FY22, and probably a market like an FY23 where things are already high, then how do you buy a good business at a cheap price? And then you need these kind of things. I'll give you one more example. In this, it was a completely different, but it was a great special situation. Of course, we did not participate in it because the stock was too expensive. But what happened was very interesting. There's a company called Music Broadcast. Now they are into the business of radio broadcasting and everything. So I would think, in my opinion, okay business, not a great business. And they have 300 crores of cash. They generate a lot of cash. The cash accumulates over time. So they had 300 crores of cash. And the promoter, the Jagran Group, very good promoters. They always look out for their shareholders from time to time. So they had a great idea. They said, we'll give out 100 crores to the minority shareholders. So they own 75%, minority shareholders own 25%. And they said, okay, this 100 crores that we'll give out, us owning 75%, we will give up our rights on this 100 crores. We don't want this 100 crores. This entire 100 crores must only go to the 25% shareholders. So while the stock was at 25 rupees and this 100 crores was actually worth only 2.5 rupees per share, but since they gave up their rights on this 100 crores, the shareholders ended up getting 10 rupees per share value. So, of course, the stock fell because the stock was too expensive. But imagine the stock right now is 10 rupees. And if we were to do this again, if Jagran Group does this same thing again, they will give out 10 rupees again when the stock is 11 rupees. Then what is your downside? Nothing. You're getting 10 rupees back and you're owning a stock practically for 1 rupee a share. Now, I'm not saying it's going to happen or not. I have no idea if they do it or they don't do it. But as investors, we can keep an eye on such situations. If the stock is cheap and they do some special situation like this, whether it's demerger, delisting, or something like this, preference share payout where the promoter is not taking and only the minority is taking, this is a great place for investors to look for great deals. So special situations is like us buying a good stock at a deep discount. It's a very good way of looking at investing. Now, this is the last slide. Um, there are different kinds of special situations which I look at in terms of how much should I give it importance, because there is so much. At any given time, 50 to 100 special situations are all over the place. Some cement company is buying from NCLT or somebody is delisting. That something or the other keeps going on. So I have kind of over the last many years kept on investing, and I've realized where the risk is and where the risk is lesser. So the higher risk is in this last category that I've written is promoter change and delisting. Okay, Murugapas come in CG Power. They're likely to change everything, but there is still a risk. You don't know what exactly may happen. So while it looks good, there is a little bit of risk. Same for delisting. You ideally they will give a good price to exit, but what if they just say no, this the discovered price I don't want, and they cancel the delisting, and then the stock can fall again. So good money can be made in promoter change and delisting, but we don't invest a big allocation in these kind of things. This can be a part of a larger book. You're taking some exposure, knowing that okay, Murugappa is great promoter, I can buy a small amount. Demergers is where I focus. This is my bread and butter. Demergers is where there is no risk, extra risk that you end up taking. You already know what the business is all about, and the stock is falling because somebody is selling, or the stock is not going up because somebody is selling. So this is something that I focus on. So this is where the allocations are higher on our end. And what I've written on top, this is where we go really serious. I mean, I'll stop doing everything and I'll focus on this. If there is a special situation followed by an open offer, this is a strong tell, a very, very important tell as to what the promoter is thinking. Now, there are so many examples. Fairchem Organics, where the demerger happened and Fairfax did an open offer at 600. The stock zoomed away from 600 to 2400. Another example was, I think, in Power India, ABB, there was an open offer by Hitachi, the stock took off. And so whenever there is a something like this, where there is a double special situation, one more was Max Healthcare, where Max Healthcare at that time was our biggest position. So at 47 per share, they did a demerger, and also there was a open offer by KKR with the new management that came in. So it was a demerger, merger. There was a 3-in-1. Uh, so that worked out great. It went from 47 at 47 rupees. No one used to even talk about it. It was like a kachra. No one cared. And even when the deal was done, where KKR signed the papers at 80 rupees a share, the stock was trading at 60, the overall thing. And the Max Healthcare part was like 47 if you adjust for the other things. So even after the deal was done, no one cared. And it demerged at 47 a share. And you won't believe, in 2 months, it relisted at 120 per share. You got a 3x in 2 months or 3 months approximately. And from 120, it was not done. It took off to 400. I think today is 450 or 460, something like that. So, whenever there is a special situation followed up with an open offer, that is where the sirens start blaring at our end. And we look at these kind of. So, this is something not which is a very, very easy thing to do, and there is no magic bullet. I mean, it's not what I said is a very convenient way of explaining, but a lot of work goes into it. Like, while the entry that you get is, that's a magic bullet, you're going to get a cheap entry price, but you still have to be right. Like, people lost a lot of money in music broadcast while the promoter gave away that freebie to everyone. People took that 10 rupees, but no one wanted to hold the stock. The company was expensive and the company was not good, so that 26 rupees thing fell to 10, so people ended up losing money. So it's not that you will do a special situation and you will also become Joel Green. That is not that easy. A lot of work must go in, and it must be a part of an overall diversified portfolio. And you must keep doing SIP. You have to look at your portfolio like a ETF in itself. Own 20 stocks approximately, and keep doing SIP. If you do this over the long term, we have seen our portfolio, our CAGR now is very good, because this is helping us even in bad markets. So this is what my thought process is on value investing, and my thought process on how to, in today's world, in today's day and time, how value investing should be done. So this is it. I'm done. I don't want to take up more of your time, and I think we have anyways touched 1:30. So Vikas, bye. Over to you.
Right. Thank you, Dil, for sharing these valuable insights with all of us. A couple of questions, if you're okay, very quickly.
Yeah, yeah, of course.
So one of the question is, why do demerger happens? Like merger only signify uh, growth. Yeah, that's
Did I get the question right? Why do demergers happen?
yeah. Like merger signify growth. In the sense, she wants to say basically that why do demerger takes place? Why does it happen?
As I said, I explained it in the first slide, is that many times you have one core business and one non-core business. So let's say, I'll give my example. The presenter, when she introduced me, she said about what we do, that's our non-core, very small thing that we used to do earlier on with the investment banking activities. Now, if let's say you are an investor in my business and we earn a lot of money doing asset management, and we are investing money in the investment banking side of things. You're saying, Neil, kya kar raha hai yaar? You're earning money in asset managing, in the PMS you're doing good, but why are you wasting money in that loss making entity, that in the investment banking thing? It makes no sense. So I said, okay, because why, I can't do anything, I have shareholders there also, so I'll split the business. आपको मैं ये दे देता हूँ, you own this, the asset management side of Negen Capital, and you sell your shares. So that's the reason demergers are done, because many a times, almost all the time, there's a misallocation of capital. That is the number one reason. And after the misallocation of capital goes away, the thought is that the main business will get re-rated. If it's getting a 15 times earnings, it's likely to get 20 times earnings or something more. So it's a value creation exercise on one hand for the big business, and on the other hand, the business which is investment banking business also, I'm very bullish, let's say. So आपने बेच दिया, भाव नीचे आ गया, but that could be a very good opportunity for somebody to look at it. So there are two ways to look at it.
Great. So what do you think going ahead in the special situation? You think that these returns that we are talking about, these kind of opportunities would remain be there in next 5, 6, 7 years in India?
I mean, this is not what is happening right now. This is happening, as I said, from the time Warren Buffett has been doing it in his Buffett partnership. This is happening from the last 70, 80 years, and probably even before that. So I'm pretty sure that this will keep happening as companies keep looking to unlock value. Why do you think Reliance is demerging Reliance Jio? Because probably they think that Jio inside the petrochemical business may not be getting the valuation it deserves. So they may be thinking that, okay, if Jio comes on its own, investors who want Jio can invest only in Jio. So of course, Reliance is too big. The petrochemical business is not likely to see forced selling. It's too big. But if it was a smaller business, people who didn't like the other part could have sold it and the price would have come down. So that's the reason.
Within the part of your long only, which is value investing, you also pay good amount of uh, contribution to digital companies which are growing digitally or maybe with help of technologies. Can you throw some lights on that quickly?
We I'm a keen believer that tech and IT kind of companies will do very good. But I also got caught up in this COVID mania where interest rates were low and these companies were growing very fast, and we made a mistake. It's great, but you can't own things which are expensive. So it was not just me, everybody. Even Charlie Munger ended up buying Alibaba. He made a $400 million loss in it. He also said, it's a good idea, but it was too expensive. So digital, I think, will grow. If companies do want to remain relevant, they will have to be digitally active. You yourself, running a wealth management firm, without a digital stack, you're not going to be able to survive without against the other wealth managers, right? You have to be present digitally. So now when you want to be present digitally, you're going to be spending on IT, and you're going to be spending on a lot of things. So a lot of these companies who are supporting, they're going to do very good. So I'm very, very bullish on the whole social media technology side, the IT side, the entire ecosystem. They're likely to grow because companies, if they have to remain relevant in today's day and time, let's say AI is coming, artificial intelligence, who in today's world and time is really ready for it? No one even knows what's going to happen. But a lot of the businesses today are completely unaware. The founders don't even know what is AI, but AI is coming at a full speed. So if you're not going to be able to have a AI stack on top of your existing stack, you're going to probably be redundant very, very soon. A lot of these companies will have products much better. So in my opinion, digital, whether it's digital advertising or whatever kinds, talking about digital things is going to have a great future. But the big learning for me is that valuations matter, and you should not go away from valuation. It'll only make sense if they are cheap.
Yeah, last question from my side. A part of your strategic allocation was more towards Nasdaq companies also. Do you continue to do so?
No, no. As I said, we've taken a step back and we've decided we'll do only special situations. So even if we do digital or tech or whatever, there must be some kind of a special situation happening, like Tips Industries when they demerge the music business out, that kind of stuff. So you must like it, but there must be some demerger, or this must be very, very cheap for me to look at it. So we don't do anything on the Nasdaq side anymore. From the PMS, we are only focusing on things that work. From our past data and our past evaluation of ourselves, the most money we've made in special situations always. Then why should, and into this last FY23, while we were flat for the year, where did we lose money? We lost money in tech and IT. So I said, forget all this. Just focus on what works. Focus on what you're an expert at. So we are just back to doing that. We're not doing anything on the Nasdaq side anymore.
Great. So we are not taking any stock specific question. There is one question which is coming up. So all the stocks that we are talking about is only used for example purpose.
Yeah.
There is no recommendation as such here. So this is the disclaimer that I wanted to share on this platform. So
Absolutely.
thank you so much, Neil, for joining the session and taking the time out. It was pleasure speaking with you.
No, thank you for inviting me. And let me just tell you, you're doing a great job for the investor community. This is something which is good. People will understand a lot of new things. So good, you're doing a good job. Take care. Have a
Our
good day.
pleasure. Yeah. Thank you.
Take care. Bye.